Hi everyone, welcome to this quarterly update. I'm Sumera Abdi and with me is our equity CIO Gaurav Mehta. So Gaurav, thanks very much. And Gaurav, now on the SBI AEON Alpha PMS, where the focus is on mid and small caps, where now people are thinking that valuations are expensive. What's your view? And secondly, what has been the performance during the recent market drawdowns?
Right. So you're right, Somera. This is, Aeon Alpha by definition is a multi-cap strategy, but you have a skew towards mid and small cap ideas. And the reason for that is that when we go down the market cap spectrum, we do find that research arbitrage, right, where we are focusing on companies which are yet not well explored by institutions because of size constraints, liquidity constraints, or just, bandwidth issues and so on. And that research arbitrage is something that we think helps from a long-term alpha generation standpoint. And to the extent that we have a strong research team, we believe in a good position to take advantage of that. So that's the reason why there's a skew towards mid and small caps. Now coming to your question on the overall valuations being very expensive on mid and small cap side, I would concur with that statement that yes, broadly if you think of the small cap index or the mid cap index and how that's sort of valued today versus larger caps, you are right in making that assessment that they are expensive. But I think the important point to keep in mind is that there are several hundreds of mid and small caps, especially small caps. Right? There are several hundred small caps in the country. And what we are doing in our portfolio is to just create a bottom-up portfolio of 20 stocks, right? Of which, let's say, 10, 11, 12 would be small caps. Now, picking a dozen small caps from such a large universe where you're not constrained for size and you can buy whatever you like, I think in turn means that you are very disconnected with what's there in the index, right? So your ability to be bottom up and to not be sort of worried about what's there in the headline index increases that much the more bottom up you are and the more concentrated you are, and especially when you're running portfolios which are only 20-25 stocks at any point in time. So to that extent, when you look at our small cap portfolio, you will find that these are companies where, when you think of some of the more popular risk measures, right? For example, when you look at the financial leverage, the debt equity ratio is actually significantly lower than even the Nifty's debt equity ratio. When you think of beta, the beta of the portfolio overall, even with such a high skew towards mid and small caps, is I think less than 0.7, right? The ROE, if anything, is slightly higher than the index. So from all of those, risk and profitability and quality standpoints, this is a portfolio which, in spite of this skew, is actually better than the headline index, right? So to that extent, again, the point is that we focus on the long run. We are focused on identifying good businesses, and therefore the headline index or the narrative on the overall macro level or the overall valuation context becomes less relevant. To your question on how we've done in market drawdowns, I think in general our experience has been that during market drawdowns our portfolios tend to do better, which is again because of the things that I highlighted: the focus on longevity of growth, quality, lower risk measures like financial ratio and financial leverage and debt equity, and all of that helps. So I think I would not so much sort of worry about the headline
Yeah, because
narratives
that's
and
immaterial.
focus more on bottom ups. Yes.
Yeah. So any movement in the headline index is immaterial to you, right? But despite that, let me ask you, because there's been a lot of volatility recently, right? Has that made you want to sort of make changes in the portfolio more often than you would otherwise do, or does that volatility also not affect the portfolio?
So on an overall basis, the answer is that we are very less sort of prone to make changes because of the overall market environment. But that said, we run a core satellite approach here. Core are essentially ideas where we are focused on the very long run, right? And there the here and now or the market cycles, etc., become very less relevant. Today, when you look at the portfolio, I think more than 50% of the portfolio is to core stocks. There's about 10% cash and there's 40% allocation to satellite stocks. Now, satellite is a portion where we are trying to also play market cycles sometimes, where if we can get into a stock or a sector before the overall market gets fancy or sort of starts to look at that sector or stock, then not only do you benefit from the upcoming sort of or the impending profit delivery, but you also benefit from a bit of valuation re-rating as other investors latch onto that theme or that sector or that stock. So to that extent, satellite has some degree of cyclicality to it, but there again our focus has been to focus on strong balance sheets, companies where financial leverage is well contained, and to that extent even there we don't churn a lot. That said, when you look at the portfolio with the core and satellite pieces together, satellite is where in an environment like this, we are sort of bound to make some changes. Core is something which sort of continues irrespective of the environment. That said, both these portions are very actively monitored. So these are not passive allocations. And if there's any sort of change in our sort of investment thesis, we are happy to make course correction. But overall, we are a very low churn portfolio.
Gaurav, thank you so much. And on behalf of Gaurav, myself, and the entire team at SBI Mutual Fund, we wish you a very prosperous Diwali and a Happy New Year.